welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we're going to try and read between the lines of the CSO's publication of the third quarter GDP estimates along with the second advance estimates for the current year with our panel of experts. Sudhita Mandal, renowned economist, emeritus professor and member of the Board of Governors of the National Institute of Public Finance and Policy, New Delhi, and Rupa Nutsirorige, Chief Economist, L&T Financial Services. Welcome to the show, Sudipto, Rupa. Well, as I said, the CSO released two sets of numbers, the GDP estimates for the third quarter of the current fiscal and the second advance estimates for the year as a whole. In both cases, the estimates are lower than what was projected to date. But let me take them one by one. Let me start with the third quarter GDP number, which at 6.6% is a six-quarter low and lower than most estimates of about 6.8 earlier. Are you surprised? We'll get into the internals a little later, but for now, let me confine ourselves to the broad level. So let me start with you, Sudipto.
Yeah, you were asking me about the third quarter number being so low?
Yes.
Yeah, no, I am actually not surprised because we had already seen that there was a slowing tendency even during the previous two quarters, and given the global situation, many of us have been saying that India alone cannot keep growing at a very dynamic pace. But what is encouraging for me is that if you look at the sources of why the growth rate has come down, it is not the investment rate, not the gross fixed capital formation rate. What is reduced things is the decline in consumption. And knowing that we have elections coming and there will be a huge spending boost and so on, as always happens, I'm not frankly too worried about it.
Rupa, would you share Sudipto's optimism, and can the decline also be explained in part by the higher base effect of Q3 in the last fiscal? Or is the slowdown more structural? Is it temporary, caused by the tight liquidity because the ILFS fiasco, etc.? Rupa?
There is a lot of noise in GDP series, but if you see the incremental momentum, quarter on quarter variation also, you see it is the growth has declined to 5 years low, which is quite significant. Of course, I was not surprised because it was in line with my expectations. And if you look at all high frequency leading indicators, they had actually communicated this story. Having said that, it remains a matter of concern for me as to what really is contributing to higher gross fixed capital formation rate. Because other leading indicators like the bank credit growth or the NBFC credit growth, I mean the credit growth of financial intermediaries put together, or imports of capital goods, etc., or project finance loans, everywhere we are seeing significant slowdown. And whether it is the small capex cycle which is taking capital formation to this level, I think there are lots of contradictions within the GDP series, and I am not convinced and I am not confident about its sustainability.
Okay, that's true. Actually, it's always difficult to join the dots in macroeconomic numbers, particularly when it comes to things like GDP in a country like ours. And so, if we turn to the internals, the slowdown is marked in agriculture, which came in at just 2.7%, well below the 4.2% of the previous quarter, and also manufacturing that also came in lower than the previous quarter. The only sector that has really done well in terms of job creation particularly is construction, which grew much more rapidly. What does this really mean for the economy? Because remember, jobs are the biggest problem. So will the growth in construction compensate for the slower growth in manufacturing? Will it absorb the surplus rural labor? Sudipto?
No, well, first of all, regarding agriculture, it is in a sense an autonomous sector, and what happens to agricultural growth is independent of government policy and so on. And we know that there has been a large slowdown in that. I mean, that's a kind of external shock, if you will, which hopefully this year, if monsoons are better and so on, that will recover. On the other thing, actually manufacturing growth, there's only a slight slowdown in this last quarter. But if you look at the annual picture, there's actually a reasonable pickup on that. And construction, of course, has been quite dynamic. So on balance, first of all, you don't know what's happening to employment given all the noise and data that was mentioned earlier. But in terms of the industrial sector production growth, if you include manufacturing plus utilities plus construction and so on, actually it's a positive. The only one that has really slowed down there is utilities, I find now. I'm now talking the annual data, not the quarterly data. The big slowdown actually you see comes in the services sector, public services, public government, defense, etc., which to me is not a bad thing, and we are quite likely to see a bump up now with the elections around the corner.
That's right. In fact, Sudipto mentioned about public administration expenditure, and that is what shored up GDP growth in the previous quarters and is markedly lower in the third quarter. While this is a good sign in some ways because it's mostly revenue expenditure, the fact is that it also just suggests the limited capacity of government to shore up growth in future, and this is also reflected in the fiscal deficit numbers. So what does this mean for growth? We don't see private sector investment pick up, government investment will come down. So what does it mean? Will growth continue to slow down, or as Sudipto says, elections expenses will shore up growth? Rupa?
Well, we have been seeing a very uneven picture in industrial growth. So some of this stimulus coming from fiscal side pre-elections may stimulate some of the consumer goods sectors. But there are many question marks, Mythili, because for last 4-5 years we have been seeing it was the public capex that was driving construction activity. And when we are seeing the public capex has slowed down this year, what is actually contributing to pick up in construction activity is also not very clear to me. So one has to wait and watch to make any inference about the trend on this front.
Sudipto, if you were to assess the health of the economy as an economist, would you look at quarterly numbers which suggest a distinct slowdown, or the annual numbers which don't show such a sharp slowdown? And the reason I ask this is that according to CSO's advanced estimates, the two job-intensive sectors, construction and manufacturing, as you mentioned, are going to perform distinctly better in this year as compared to previous year. But we don't see much evidence of that in the quarterly data, particularly for manufacturing. So what would you give much credence to? Of course, one is setting aside the entire controversy about the new series, but broadly speaking, would you go by the annual data, which is not such a bad, doesn't present such a bad picture, or the quarterly data which presents a distinctly less optimistic picture? Sudipto?
Yeah, first of all, high frequency data obviously is preferable to the annual data because it gives you the latest picture, the most current picture that you can get. However, to draw conclusions about secular trends or longer term trends from the quarterly data, you should not look at only what happened this quarter compared to last quarter. Then you need to look at a series of quarterly figures. And I set a lot of store by investment, gross fixed capital formation, which is really the sustainable driver of growth. And if you look at that figure, not just last quarter, if you look at several quarters going back over the last couple of years, so I'm talking about 6-8 quarters, you find that there's been a consistent recovery of the investment rate, which, as you know, had really slowed down in the Indian economy. So to me, that is the brightest picture, if you will, a brighter sign in the horizon. However, we must also be realistic. The global economy is going through fairly troubled times, and we cannot expect that an economy like India is going to be growing at 8-9% when the rest of the world is slowing down. So I think if we make 7% growth this year for the whole year, which is we may either just above or below 7%, that is my reading, I think we're doing fine. I mean, a 7% growth rate when the rest of the world is growing at like 3% or 4% is pretty good according to me.
Oh yes, you're right on that, Sudipto, except that we really need to grow so much faster and our potential also should be higher. But Rupa, with the wisdom of hindsight, can we say today with greater certainty than before that the high real interest rates close to over 4% due to RBI's excessively tight monetary policy have actually hit both consumption and investment demand. Remember, in August last year, the RBI hiked interest rates and in October changed its stance from neutral to what it called calibrated tightening. Could both these now seem to have been, really going overboard? Rupa?
Yes, I personally feel that they were more hawkish at that time than needed. But then, RBI always goes by forward-looking expectations on inflation front, and there were also many components of inflation, especially core inflation, which primarily represents demand pull forces. They were not able to establish with certainty whether the trend was moving in either direction. So they had adopted wait and watch approach. But then, I personally feel that slowdown in demand, the story of slowdown in demand was quite obvious because rural inflation was collapsing at a faster pace. And when we had seen, because of uneven distribution of monsoon and depletion of water reservoir levels, sowing of both Kharif and Rabi crops this year had suffered. So food inflation for us may be, a proxy of inflation, but for rural people, it's a proxy for income. So definitely, the slowdown in overall demand has come more from slowdown in rural demand. So now I think that realization has dawned upon, plus NBFC sector, which suffered from perception crisis or crisis of confidence. Many of the MFIs and HFCs had to hugely curtail their disbursements in second and third quarter. So that has also impacted the growth of a lot of agro-based industries and small enterprises. So all that is now getting reflected, I think, both in high frequency data indicators as well as GDP statistics. And RBI has realized that, and I feel that in their next policy, they will also revisit their growth projections, not just for FY19, but also for FY20.
Sure. I'll come to you, Sudipto, again on the RBI's real interest rates, but after a break, because now I'm afraid it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're trying to make sense of the latest GDP numbers, the third quarter GDP numbers, and the second advance estimates for this year, just released by the CSO with two experts, Sudipto Mandal and Rupa Nitsure Rege. Sudipto, before the break, Rupa and I were discussing the high real interest rate of the RBI and what could be the contribution of that to slowing demand, particularly consumption demand and investment demand, which even though it hasn't collapsed, has not really picked up dramatically. So that's my first question to you. And a second related question is that both the RBI and the government now seem to be going into overdrive to stimulate the economy. So is this likely to move the needle in the fourth quarter? Because the CSO doesn't seem to think so, since it's lowered its estimate for the annual GDP growth down from 7.2 to 7%. And this is also, mind you, well below RBI's original estimate of 7.4. What is your sense, Sudipto?
No, as I said earlier, when it comes to quarterly data, you always have to look at the latest numbers, latest data that is coming in. And the CSO's projections now are based on more information than the RBI's projections earlier. So this is the one that one should be looking at. And my judgment also is that we are likely to be, as I said earlier, somewhere in the ballpark of 7% rather than 7.4% growth for the year as a whole. Coming to your question of interest rates, as I think Rupa was mentioning earlier, the slowdown in demand, a large part of it is actually from the rural sector, the agricultural, farmers' distress, etc., that has been widely discussed. Whether that is particularly sensitive to changes in interest rates, I am not sure. That being said, I think our real interest rates have been very high and they need to be brought down, given that the inflation is so low, and we should really be looking at real rather than nominal rates of interest. And I think I agree that interest rate should be brought down. But again, to think that just that change in interest rate is going to, in a high frequency observation, that namely the fourth quarter, you are going to see a revival in growth, I think would be unrealistic. There are factors like what's happening in agriculture which impacts the rural sector and public expenditure, that is the fiscal deficit and the budgetary expenditure, which have much sharper, quicker effects on aggregate demand than the interest rate, which operates, through the cost of money for those investing and so forth.
Oh yes, I
So
would
I don't think you'll see a big change
Okay.
in this in the next quarter.
Okay, I would
because
agree.
of the any change in stance on the interest rate, but I think it should be brought down.
Okay.
The real interest should be brought down.
I would agree with you again entirely on that, Sudipto. A, because monetary policy acts with a long lag. B, it has very limited impact as far as rural consumption is concerned. But Rupa, as far as the same question that I asked Sudipto, is the government and the RBI going into overdrive now with fiscal and monetary stimulus in whatever degree? And is this likely to perhaps, have a repeat that we will overstimulate the economy, particularly when elections always act as a stimulant in any case? Rupa?
No, I don't think so, Mythili. This time, first of all, the fiscal space is very limited. And we don't have much time left for elections, and whichever government comes to power, definitely in the first year it will focus more on fiscal consolidation and cleansing of balance sheets, etc. So I don't think, we don't now have the space which we had in 2008-9. Also, Reserve Bank of India, I think they are bound by a rule-based framework, inflation targeting framework. So they cannot go overboard. But yes, there is lot of scope for them given the fact that there is sustained deflation in food prices, and oil prices also have come down significantly from their peak levels in mid-October, etc. And also overall demand forces are also slowing down. Having said that, I feel that FY20 will be an year of adjustment, both on the fiscal front, and economy will have to witness lot of headwinds coming from global arena, as well as there is a prediction of El Nino, so monsoon may not be that good. So I think even if we protect the growth rate around 6.5%, we should be happy, because we cannot stay insulated from global economy.
So, Rupa spoke of the limited fiscal space. Now, as a fiscal expert, do you really go by this very rigid fiscal deficit target, or should we have some flexibility? Because it's a question of how you use that fiscal space, what the fiscal deficit is used for. So, would you think that there is very limited fiscal space?
Yeah, Mythili, I suspect that we are speaking in terms of different time frequencies, whether we are talking in terms of quarterly or the annual picture. Let me now talk about the annual. As far as that is concerned, I agree that post-election, whichever government comes to power, the first 1 or 2 years of the new government would be a period then where it would try to maintain strong fiscal prudence. And so in that time frame, I'm not talking about this quarter. I think this quarter we are going to see somewhat profligate spending run up to the election. But if you're talking about the first year of the new government, I think it will be fiscally fairly tight. That would be my reading. So given that, and I still think that that is another reason why the real interest rates should be brought down. The monetary policy framework was mentioned, where you have very low inflation rates. There is some room for improvement of methodology on the forward projection of inflation rate. But given that the inflation rate, I mentioned interest earlier, I'm sorry, I meant the inflation rate being so benign, I think there's, on the monetary policy side, I think there are good reasons for the RBI to bring down the interest rate.
Oh yes, that's what everybody says right now. But I have a follow-up question with you, Sudipto, particularly because this is an area that you know very well, that the latest back series of GDP data released by the CSO threw a number up threw up a number of surprises, including the surprisingly high rate of growth of 8.2% in fact, the demonetization year. Do you think we'll see a similar revision in for 2018-19, because whenever revisions happen, they've usually been upwards. Of course, we have seen downward revisions at times, but broadly, it has been upward. So can we hope to get an upward revision, because there's such a huge informal sector for which the data typically trickles in much later? Sudipto?
Well, I don't know. It depends on the informal sector. What you're quite right. The second advance estimates are also based on data that is there, probably till September, in some cases for some variables till December. So the revised estimates that come up, those actually will be based on better information. But the question is whether it would be upward revised or downward revised will depend on what's actually been happening to the informal sector. And it is not clear to me that the informal sector is going through any distinct revival. So I would expect that when the next set of numbers come, they will show pretty much the same picture as you've seen now in the second advanced estimates. That is a growth rate of somewhere close to 7%, plus or minus a couple of percentage points. That would be my expectation.
Quite possibly, because one of the effects of demonetization supposedly has been that the informal sectors, the size has come down. So would you agree, Rupa, that we've got most of the data we've already received by now, and we can't expect much upward revision, at least in the sense of the informal sector's contribution? Would you agree with that assessment, Rupa?
Yeah, I completely agree, because it is the informal sector that has suffered maximum this year. Because of curtailment of disbursements by NBFCs, because NBFCs in a great measure cater to informal sector. Also, the slowdown in agriculture also impacts a lot of agro-based activities in informal sector. So if you take into account these factors, upward revision in the gross value added of informal sector, I think the chances look very limited to me.
Okay, so not much reason to hope for any upward revision. Sudipto, now let me turn to the gross fixed capital formation. You spoke about the fact that it has picked up, but if you look at the numbers, they're slightly contradictory, because the growth for the year is only marginally higher in constant terms and is actually lower in current prices. But if you look at it as share of GDP, yes, there is an improvement. So can we really say that we are out of the woods, particularly because private sector investment, frankly, is not going to pick up until we know the shape of the next government? So we'll have to bide our time to see private sector investment pick up. So what is your outlook for investment? Sudipto?
Yeah, as I said, when you're using high frequency quarterly data to infer about what is going to happen in a longer term time framework, you should look at a series of quarterly numbers rather than just the latest. And I think if you look at that series, you will find that both in terms of growth rates in real terms, growth rate of fixed capital formation, as well as a percentage of GDP, it has been now consistently rising. I mean, now I think we are close to something like 33%, it's 32.3% or so. And it is not yet reached the peak that we had reached of something like 34% of GDP earlier, but we are consistently approaching that. Now, what is driving this? How much of it is led by public investment? How much of it is revival of the private sector and so on? Is something I'd have to dive deeper into the data before I can give you a confident answer on that, because I frankly haven't had the time to do that. But certainly the fixed capital formation increase as a percent of GDP is a consistent picture over several quarters.
That's true, that's true. But we're running out of time. So Rupa, your quick take on gross fixed capital formation.
As I said earlier, I don't share that confidence, because all other indicators which are bearing on investment sentiment, we have not seen any significant revival. We have been very closely tracking quarterly corporate earnings. We are seeing, working capital versus term loans extended by banks and NBFCs. If you look at to sequential growth momentum in core industrial sector, infrastructure industries. If you see the current state of realty or large real estate developers, there isn't enough ground, or even credit rating agencies, you know, upgrades to downgrades ratio. All these indicators are not giving a clear picture or signal for any signs of investment revival. So I would really like to wait and see as to which sectors which sectors are contributing to actual firming up of gross capital formation rate. Because even imports of capital goods, if you take non-oil, non-precious metals imports growth, that is also continuously negative. Earlier years we have seen that whenever capital formation information used to present robust picture, we used to see other factors which I just mentioned, they also used to show good pickup in growth momentum.
Sure,
but
agreed. It's very much I must interrupt you here, Rupa, because we're really running out of time, but I agree it is very much a mixed picture. So Sudipto is a little optimistic, Rupa much less so, but I do hope for the sake of our country, Sudipto is right, and when the final numbers come in, it will be somewhere in the range of 7%. Thank you so much, Rupa and Sudipto, for joining me in the discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.